and welcome to Moneylife News and Views. I'm Debashis Basu. The stock markets all over the world have come a long way from the sudden crash they suffered in March and early April 2020, when COVID gradually brought the whole world to a complete standstill. The markets, though, kept rising like phoenix, braving severe lockdowns, high unemployment, business shutdowns, migrant labor crisis, and a complete stoppage in all travel and entertainment businesses, and of course, worried about uncontrolled rise in bad debts of banks and financial institutions. This miracle of a market rally occurred partly due to stimulus packages unleashed by the governments, and partly because most businesses were allowed to resume operations from June 2020 onwards, and many of them had their costs going down due to lower overheads and virtually no travel. Then came the quarterly results, which dispelled any notions of a slowdown. Indeed, by September 2020, India Incorporated was displaying the kind of vim and vigor that has been missing for years together. In other words, everyone was fooled by the feared impact of the pandemic. All the doom and gloom stories turned out to be wrong. As the months progress, and 1 year since the hard national lockdown rolled past in March 2021, only armchair commentators with no skin in the game remain skeptics. Some predicted another crash in prices, but professional investors got busy in making money. More importantly, a combination of factors unleashed a tsunami of retail participation in the Indian stock markets. Look at these numbers. From just 4.08 crore of demat accounts opened in 2 decades till 2019-20, 4 crore in 20 years, the figure jumped to 7.4 crore, almost double in just another 20 months by the end of November 2021. This is a kind of massive retail participation that has happened. A second COVID wave with horrific stories of oxygen shortage dampened this speculative fervor, but only a little bit. As the second wave receded, the market rose once again. However, just when everyone seemed to be convinced that the stock market is bound to keep rising every quarter and every year, as though it's our birthright to expect this, the stock market seemed intent on fooling us all over again, now in a different direction. On 19th October, the market indices hit their all-time high and started to drop over the next 2 months. A strong up move in late December and early January ignited hopes for another rally to all-time high, but this time it was met with massive selling from 18 January onwards. The immediate cause is a sharp fall in the US markets, in turn caused by policy changes announced by the US Federal Reserve, which is worried by the sharp rise in inflation. How big is the rise in inflation? The US Consumer Price Index climbed 7% in 2021, the largest 12-month gain since June 1982, according to the data released on January 12th. The Federal Reserve, in response, has hinted that it may raise interest rates this March, while Bank of America thinks that there could be as many as 7 hikes this year. In addition, it is likely the central bank's holdings of over 2 trillion US government bonds and mortgage-backed securities will be shrunk, which is the government will, with the Federal Reserve will start shrinking them. These two moves, which is a higher interest rate and a shrinking holding of government bonds and mortgage-backed securities, would reduce liquidity and increase interest rates. The immediate fallout, according to conventional wisdom, is that money would move out of risky assets like stocks, with the riskiest part of the stock market, which is small cap, technology, and emerging markets, getting hit the most. This is exactly how it's playing out till now. However, this is common knowledge among investors now, and markets rarely do what is expected of it. Besides, the reality of the marketplace is far more complex than the simplified reality offered up for public consumption by media headlines and opinion pieces. So what could be the true impact of the major policy shift announced by the US Fed? We are witnessing the initial knee-jerk reaction in the form of indiscriminate selling of stocks over the past 10 days. Even institutional investors tend to succumb to such simplified correlations like Fed hike, so sell stocks. This will certainly take some froth out of the markets since the 18-month bull market has seen too many stocks that have been pushed far beyond reasonable valuations. Cyclical stocks have been valued as growth stocks, while small cap stocks with slightly improved earnings have relentlessly risen. Large cap stocks, especially in consumer goods with very average growth prospects, have been pushed up to really super heights. There is overvaluation and excess in many pockets in the market. This is most obvious in case of initial public offering market, where loss-making companies like Paytm or Cartrade or Zomato and Nykaa have inflicted large losses on investors. This is a cycle that plays out repeatedly. A bull market induced by an easy money policy, indiscriminate valuations, excesses in adjacent markets, this time in new markets such as cryptocurrencies and non-fungible tokens, private equity, and so on, and eventual big declines in asset values. This same cycle is playing out all over again. Depending on how things unfold, stock prices could head too far in the opposite direction. This is not necessarily given, as many market commentators are predicting, but a possibility. Unfortunately, the market today has millions of new investors with no investing experience and behavioral fortitude to separate the wheat from the chaff, to ride out the declines and possibly buy quality stocks if they are available at low prices. It is their actions, like that of newbie drivers on the road, that will determine the immediate trajectory of the market, even as the market tries to fool the majority once again. Thanks for watching. And if you really liked it, just click on the like button and subscribe to this channel. Thank you.